Welcome to Retirement GPS, navigated by Zenergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome to the 44th episode of the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and president of Zenergy Retirement Planning.
And I'm your co-host, Zane Belsack, associate planner here at Zenergy.
We got a great topic today, Zane. So what we're going to talk about is annuities. Ooh, controversial annuities. Do I buy annuity? Do I not buy annuity? For people that love annuities, they are the product that's going to solve all of their problems. And for people who hate annuities, they are the devil. They are something that should be strongly avoided at all costs. So we're going to cut through the nitty gritty. We're going to cut through all of the conflicts of interest and dive down to the quick to say, listen, what is important about annuities? How should we think about annuities? And are they a vehicle that we want as a part of our retirement planning process? So let's start high level, essentially. What are annuities and how do they work? So annuities are insurance contracts. Remember, these are not investments. There is a difference between an investment, which we put our money into. We expect to get our money back someday. We expect to get either interest or growth out of that investment, or perhaps dividends. Annuities are not that. Annuities are an insurance guarantee. They're an insurance contract, and they're designed to provide income and guarantees of certain things, certain features. There are many types of annuities. The main type, which we're going to spend a lot of time talking about today, is what we call an immediate annuity. Okay, an immediate annuity means I purchase it and it starts today. That's typically coupled with a fixed annuity. So a fixed immediate annuity is what we like to talk about. It's because it's the plain vanilla type of annuity. It's the type of annuity that we can compare apples to apples. Once you start adding in riders and all these different things, it gets very tough to compare apples to other types of investments. But a fixed immediate annuity is I give a lump sum of money today, and starting immediately, I'm going to get a stream of income for the rest of my life from that insurance company. There's also indexed annuities and variable annuities. An indexed annuity is tied to an index such as the S&P 500. So I'm going to put my money away. It'll fluctuate. Theoretically, it'll grow. These indexes, typically these annuities have caps and floors on them, right? So we can only earn so much. If the S&P is up 30%, I can only get 6% of it, and the floor is zero. I can never get less than zero in a year. And variable annuities work very similarly the same way. They just may not be tied to an index. They're often marketed around things like guaranteed income and downside protection, market participation with a lot less risk, and the guarantee of being backed by an insurance company. So that's really what an annuity is and how they work.
Now, I'm really interested, and you mentioned this before, but I know a lot of people either love them or they either hate them. I've also heard there's some salesmen that do classify an annuity as an investment. I know that they're so complicated. Why exactly are they so controversial in the industry?
It's a great question. Why are they controversial? Number one is because annuities tend to be sold. They're typically not bought. People often don't go out looking for annuities. It takes a salesperson to sell an annuity. And there are people that base an entire career, very successful careers, off of selling annuities. And because they're sold, most of the promises of an annuity, the good parts of an annuity, are pitched, and the negatives are not discussed. And that often becomes a problem because there are positives and there are negatives. Whenever it comes to insurance, think about life insurance. Life insurance is a really simple type of insurance, right? I'm going to give you a small amount of money every single month or every single year, as long as I have this insurance policy. And in exchange, you're going to promise my estate or my heirs a large chunk of money if I were to die. All right. Now, that's a very simple insurance promise. And what we understand is that we're giving up something to get something back. We always have to give up something to get something back when it comes to an insurance product. And that's what we're doing. We're giving up that premium. We're giving up that monthly or annual sum of money to get back a promise, right? Now, in annuities, they talk so much about the good things and the promises that they leave out the negatives and the things that we are sacrificing in order to get that annuity. Fees often are very high. So they're controversial because once people sign up for an annuity and they see what the fees are, they're pretty blown away. Most of the time, once you sign up for that annuity, you're locked in. So that lack of flexibility is the third reason they're so controversial. Once you're in an annuity, you're in an annuity. Now, a lot of times you can get out of them at some point. There usually is a surrender period where there's a surrender charge, and it can be significant if you try to get out of annuity very early on. But over time, that surrender charge diminishes and disappears. So annuities typically have those surrender charges. And these things, these overpromise, the high fees, lack of flexibility, these are the things that really kind of create this controversial setting around annuities. And frankly, most people that come to us typically will say, they talk about all their other investments and they're usually either positive or neutral about them. They pull out their whole life insurance or their annuities, and that's really where they're like, oh, and this thing, I got this thing. They just kind of don't understand what they're getting themselves into, and that leads to the frustration and the controversy.
Yeah, I noticed a lot of frustration too, especially with the lack of flexibility, like you were saying. It's very hard to get out of it, and you don't want to have to keep paying surrender charges over and over again to get out of an annuity, right?
For sure.
So this might be the portion of the podcast where the annuity haters might turn it off, but I'm interested in learning, what are the benefits of an annuity? Why should a retiree really consider an annuity?
Yeah, and they are so controversial, but the truth is there are benefits to an annuity. As a financial planner, we can't ignore those benefits. First thing is a guarantee, right? When we invest someone's money, even in a diversified portfolio, the one thing that we cannot do is make a guarantee. There is no guarantee. So in a diversified portfolio, we don't have guarantees. We have high levels of certainty and high levels of probability, but there's certainly no guarantees. The insurance company can make that promise. The insurance company itself guarantees the payout. And then if they cannot pay out because for some reason they become insolvent, there is a reinsurance or a state fund that actually backs up those insurance companies to make sure that they can pay out what is promised. So as high level of guarantee as we can expect in this world, which is really helpful. The second is annuities tend to be very stable and avoid the market volatility. Even in things like indexed annuities or variable annuities, they tend to have floors where your money's not going to go down, even in a really bad market. And I know we haven't had a bad market in a while. This is 2026. Some of you may remember 22. Some of you really don't remember a terrible market since 2007, 8, 9. That was pretty lousy time. And if you're sitting there watching your retirement savings plummet, you know the importance of what guarantee and stability can offer. The third thing that is a real positive is the higher income in early years of retirement. When you are first retired, those are the years that you tend to want to spend the most, right? We call those the go-go years, the honeymoon years. You're out there and you're traveling and you're going out to dinner and you're meeting with friends and doing all the fun things that you've always wanted to do when you had the time to do it. Now you have the time, and with an annuity, you actually have a little bit more money because their distribution rates tend to be higher initially anyway than drawing from a diversified portfolio. So that higher income in the early years can be really beneficial and allow you to lean into the go-go years, especially if it is a little bit tight as far as retirement and how much you can spend. And then lastly is the longevity insurance. This is always a really large positive on the longevity insurance side. The annuity guarantees that no matter how long you live, it is going to pay out its stream of income, which is awesome. Right? We just don't know how long we're going to live. And I will go on record and say most people underestimate their life expectancy, because how do people calculate or think about their life expectancy? Zane, if I said to you, how long do you expect to live? And I know you don't have a crystal ball. I know you don't have an answer. But in your mind, give me a range. Give me a 10-year range. Roughly what age do you think you're going to live till?
That's a tough question. Honestly, I'm a pretty young guy. I would hopefully say 90 to 100.
Great. Awesome. Now, what makes you come up with that range? What makes you think that 90 to 100 is the range that you're going to pick?
It's really a broad guess, but hopefully medical technology gets a lot better as I get older. So that's why I chose a little bit of a higher number.
Yep. And that's fantastic. Zane's a pretty forward-thinking guy. Most people actually don't think like that. Most people actually think that they base it off of how old their parents or grandparents lived till. And they say, my grandparent died at 76. My parents died at 75. I'd pretty much be lucky if I lived to 80. But they actually discount the medical technology and the healthier living habits that we have today than generations ago. So longevity risk is a real thing. And if medical technology it continues to advance the way it is, we could see a good percentage of the population living well into their hundreds. So longevity insurance is a real value there. Because of these four things, we've got the guarantees, we've got the stability, we've got the higher income in early years, and we've got the longevity insurance. These four things make these annuities really compelling when we're talking about taking a lump sum and turning it into a stream of income.
Now, this actually might be the first podcast I've ever listened to, or in this case, been a part of, that actually talks about the positives and the negatives of an annuity. So those of you that hate annuities, you can come back on, don't worry, because I'm going to ask Ryan, what exactly are the downsides of an annuity? Why should a retiree be cautious of these?
Yeah, obviously they have very favorable components, right? But as I said, with life insurance, if life insurance didn't have a premium, we would all get as much life insurance as we could take, right? Why? Because it's free. There's no downside. The downside is the premium we have to pay for that life insurance. Whenever we get something from an insurance company, we give something up. That is the trade-off of insurance. What are we trading off? Now, the problem is this is not communicated well. In fact, most of the time it takes a CFP, an accountant, or somebody who's really good at Excel to sit down and break out an annuity and compare it to an investment strategy over a long period of time. In fact, it's something we do for our people pretty regularly. We just did 2 annuity analysis in the last month because we had retirees that were pitched annuities that looked too good to be true. And we did the analysis. We showed them the pros. We showed them the cons. And they were like, yeah, that's not a great product for me for what I want. We don't want to say annuities are all bad, but there are downsides to annuities. Let's talk about the first downside. The first one is inflation, right? We're going to talk about a plain vanilla annuity, which is I give a lump sum of money and in exchange, I get a stream of income. Now, in most of the cases, that is not inflation adjusted income. What that means is if I have $500,000 and in exchange for that $500,000, I'm going to get roughly $3,000 a month, which is about what we can expect from an annuity, maybe a little less, $2,800, $3,000 a month. Guess what? If I'm 62 today and I lock in that annuity, guess how much money I get a month when I'm 92?
$3,000.
$3,000. Good answer, Zane. You're paying attention in class. We get $3,000 a month when we're 92. What do you think is going to happen to our property taxes, the cost of milk, the cost of eggs between the time I'm 62 and the time I'm 92, Zane?
I can only imagine. What, it's going to double, triple?
Yeah, it'll go up. That's all we can
yep.
promise you. I can't promise you it'll double or triple, but I can promise you it will go up. Sometimes it'll go up really fast. Sometimes it'll go up really slow, but it will go up. I've heard people say, even when inflation was 1% and 2%, oh, there's no inflation problem. Why are you concerned about inflation? I said, there is inflation. It is a problem because over a long period of time, inflation compounds like everything else. So it goes up. Now, if we're getting the same amount of money in year 1 as we're getting in year 30, we're effectively taking a pay cut in real terms every single year. So that's a problem. The nice thing is you do get a larger benefit. You do get a larger stream of income in the early years, right? Because it's a little bit more money than we would be taking from a diversified portfolio. But in a diversified portfolio, in our model, you increase your distribution rate every year to keep up with inflation, and in the annuity you do not. So because of that, you are going to take that pay cut over time, and it's actually going to be less and less favorable over time. Now, you can get an inflation rider on your annuity, and if we get that rider, guess what? All of a sudden now, our distribution rates don't look so good because we got to pay for that rider. Remember, there's always a trade-off for something that we get for something we give up. So we're going to get now inflation adjustment, and in exchange, we're going to pay for that rider, and that payment is going to take our distribution rates way down. We saw an interesting annuity recently where as long as the principal that you put into the annuity was still active and involved, meaning you hadn't distributed that principal all in its entirety, you will get the inflation adjustment. Once the principal is distributed completely, the inflation adjustment disappears, and then the rate is locked in. The distribution number is locked in for the rest of your life, which is almost like, yeah, you get some inflation adjustment, but not all. And what I mean by that is if you had $500,000 and you were taking $3,000 a month in our analysis, that's a distribution. So every month, $3,000 comes off that $500,000. When it's gone, which is about 10, 11 years, that inflation adjustment stops. So it's really interesting to see how they manipulate the numbers in an annuity to make it look attractive, but ultimately still benefit them mathematically. Annuities are a bit negative because they tend to have lower growth. underperformance against a traditional diversified portfolio. Certainly, there is no guarantee of that. We do not know what a diversified portfolio will provide you over 10, 20, or 30 years. But historically speaking, that would typically be a problem, underperformance. Think about a floor and a cap. A lot of these indexed annuities or variable annuities look so compelling because they're like, look, you're going to get the S&P 500 with no risk on the downside. Guess what? If we're going to be capped at 6% and then floored at 0, we're either going to get 6 if the S&P returns anything above 6, or we're going to get 0 if the S&P returns anything below 0, or anything in between 0 and 6 if that's where the S&P falls. If you average that over time, you're probably going to get about a 4% return, about the same rate of return over a long period of time as the 10-year Treasury bills. So you're not getting a very good rate of return, even though it looks like you're getting the quote-unquote S&P 500. And that's what we've seen. They make these promises about what you're going to get and get you all excited, and then the actual returns settle in. Oh, and by the way, we didn't even talk about fees yet, because that 4% is going to probably have at least a 1% fee attached to it that is going to eat away at that return. That 4% is not very palatable. The third is liquidity. If you do have a fixed immediate annuity, I'm giving you $500,000 and you're giving me $3,000 a year for the rest of my life, there is no liquidity there. And that means if I need $100,000 because there's an emergency that I didn't foresee and I didn't set enough aside, I cannot access that $100,000. I do not have that principal anymore to draw on. I'm getting $3,000 a month, and that was my promise, that was my commitment, and that's it. Once again, you can get a rider. A rider is an addendum to a policy or to an annuity to add a feature to it, right? So you can get a rider to add liquidity where you can draw on a certain percentage of the portfolio if you need to, or a certain percentage of the principal if you need to. But again, that's going to reduce your income stream over your entire lifetime dramatically. Not something that we typically, when we're comparing apples to apples, not something typically that we can talk about. If you buy an annuity and you use the assets over time, you're typically leaving little to nothing for your children or your heirs. So again, in the situation, the two annuities we looked at recently, if I invested $500,000 and I'm getting $3,000 a month, that's $36,000 a year. At the end of the first year, my $500,000 has been reduced by $36,000. So I'll do some simple math. I think that's roughly $464,000 that we're going to have left. And the next year we're going to be reduced by another $36,000 and $36,000 and so on and so forth. If I die after year 12, 13, whenever that $500,000 runs out because I've distributed it, my kids get nothing. My kids get the difference between what the principal was and what I've distributed, right? So they may get $100,000, but that would be it. In our diversified portfolio strategy that we draw from, the principal actually typically grows over time. It doesn't shrink. No guarantees of that, right? Remember, we're giving up the guarantee, but it typically will grow. In the 20 years that I've been doing this, unless somebody's overspent, it has grown. So we haven't had anybody who has run out of money in that 20 years unless they way overspent what they were supposed to spend. Number 5, less real, i.e. inflation adjusted dollars later. So we talked about that, right? We talked about inflation being a problem. Down the road, you're going to have a dramatic pay cut. I guess this is a kind of a dovetail on number 1, so I apologize for the duplication. But just understand that the $3,000 that you're collecting in 2026 may be something to the equivalent of $1,000 in 2056. So if you are 62, you plan to live to 92, as Zane does, then we're going to have a problem. We're not going to have enough money to make sure we're paying our taxes. Number 6 is fees. So the fees are significant in an annuity. And guess what? Once you buy that annuity and you're locked into that contract, you don't have any control over it. A lot of those fees are already laid out in the contract, so you can peruse them and make sure that you know them. But a lot of the underlying investment fees, if you do buy an indexed annuity or a variable annuity, they invest in financial products. So the S&P 500, they invest in mutual funds that you get to pick. So it looks like an IRA. Look how cool this is. What they don't tell you is that if you invest in your IRA, you can buy funds that have fees of 0.05%, 0.06%, very small dollar amounts. When you invest in an annuity, a lot of those funds have 1% to 3% fees. And I'm no mathematician, but I have to tell you, if I'm hoping to get a 6 or 7% return and I'm paying 3% in fees, basically half of my growth is going to the annuity. And then how much is Uncle Sam going to take of that? So it's a big chunk, and it's definitely not palatable, especially at those high ranges of fees. And then the last thing here is lack of flexibility. There is a tremendous lack of flexibility when it comes to your annuity. You give up your principal that we talked about that you can't use. You also don't have the option to increase or decrease your distributions. Let's say that you don't need as much money because something happened and now you want to take less money. That's not even an option. If you need to take more money because something happened, even though it may not last as long, that's not an option. So lack of flexibility is a problem. In financial planning, we say flexibility is a very important feature. One of the times we do give up flexibility, and we understand that, is an IRA. So we understand when we put money in a Roth IRA or a traditional IRA, that is designed for our retirement. And we give up that flexibility, always trade-offs. We give up flexibility for tax-free or tax-deferred compounding growth, depending on the IRA that we're in. And we accept that. We're comfortable with that because the tax benefit is so great. In an annuity, it's not so much about the tax benefit, it's about the guarantees, it's about the other things. But know that we are giving up flexibility. We need to account for that. So just make sure you know what you're giving up for the things that you really want.
I don't even know what would anger me more, the lack of inflation growth, the fees, the tremendous fees, or honestly just the lack of flexibility to just make me very uneasy.
Yeah, and it really is the problem with people who are not knowledgeable when they walk in or talk with an annuity salesman. Annuity sells them all the positives, all the guarantees, payment for the rest of your life, but doesn't talk about the negatives. And then over time, they see those negatives in real time, in form, because that payment just doesn't feel as much as it used to feel because costs have gone up so much. I got to tell you, the costs change over the last 10 years alone would make annuities feel really painful right now, simply because of COVID and the inflation that we saw in the early 2020s. But I do want to temper that conversation to say that there are places where annuities still fit. There is a time when we want to take an annuity stream of income because we're willing to give up those negatives for the positives that annuities provide. Especially a lot of people that we work with may still have a pension. We have the option of taking a lump sum or taking an annuity. And we take a look at that. And we take a look at how much Social Security do they have? Do they have a certain threshold of guaranteed income coming in? Social Security is really, in my opinion, the best annuity in the history of the world because it's guaranteed by the federal government, best guarantee we can get. It's inflation adjusted, right? So it does go up with costs over time, and it's tax efficient. And we can debate the tax efficiency of an annuity, but my personal opinion is they're not terribly tax efficient. Investments aren't terribly tax efficient either, specifically an IRA. Roth IRAs are very tax efficient. But a traditional IRA is also not terribly tax efficient, and Social Security is. So we have that real benefit there. And if somebody has a fairly substantial Social Security benefit, we probably want to take the lump sum and not the annuity. But it really depends. It depends on the situation. If you have a really low risk tolerance, if you wake up and you see your portfolio that's $500,000 fall $5,000 in one day, by the way, that's 1%, and it makes you want to throw up, you're probably a good candidate for an annuity. Why? Because your lifestyle is just as important as your money, right? So being comfortable and being able to sleep at night is really, really part of the comfort that we want to provide there. And we have recommended annuities to people that really just could not stomach any kind of volatility. The essential income gap in retirement, really trying to make sure that we have our essentials covered. We try to plan that in advance, especially if we're working with people 5 to 10 years before their retirement. Make sure that your mortgage is paid off. Make sure that we've got as much of your bare necessities covered as possible through things like Social Security. That way the distributions from your retirement account are mostly discretionary and high-level living expenses that could be cut if needed to. Not that we need to cut them, but they are discretionary. If we need to fill that essential gap, sometimes we'll take a little bit of money and recommend it goes into an annuity. No pension income. So if you have no pension income, you have no Social Security because you just didn't work for those 10 years, an annuity may be a good option. And these are really the areas that we're looking at to make sure that there also may be some value in solving a specific planning problem. So it's not really our default recommendation, but we have in one situation, we recommended an annuity. We had a doctor that had a very high net worth, and he really had done so many things right. He had pretty large Roth accounts, pretty large pre-tax accounts. He had a pretty significant taxable investment account. He had some real estate. And he got pitched this annuity by an insurance person. And he said, could you look at this and put it into my financial position? And I looked at it and I said, listen, for the amount of money that you're looking to do, it's a guaranteed life annuity to manage longevity risk. And we have other things in place that will offset inflation, that will offset the problems that annuities create. But It's a great little diversifier to the portfolio. So he purchased that annuity. It wasn't a big annuity. We told him what the downsides were, the upsides and the downsides, and he was comfortable, and we moved forward with it. So like I said, just being knowledgeable going into it is really important.
Now, it's a good segue into our next topic, which is really just some questions retirees should ask before buying. But all the positives, all the negatives that you mentioned, the fees, the inflation, the growth, it all varies depending on what contract you get. And every contract is somewhat different. It's like a snowflake. And this is a good practice of what we do around here is we always want to get the contract and read through the contract, look at the riders, the different types of benefits and disadvantages that you're getting. And I think it's a really good practice for what you should do as well.
Yeah, it's a great point. And we've come up with a list of questions that we'd like to see you ask before buying an annuity if you're not working with a planner that can analyze it for you. But the first one is, what problem is this annuity solving? What are we trying to solve for? What is our problem? Could it be market volatility that we're afraid of? Could it be we're worried about longevity risk and want guaranteed income? But what are we solving for? Okay. Also, what am I giving up for this guarantee? If you don't know what you're giving up for the guarantee, you're probably giving up too much. Okay. Almost certainly we need to be knowledgeable going into it. What am I giving up? How much liquidity will I lose? Meaning, what will I have access to? What will I not have access to? And will that be a problem down the road? What is the total annual cost? What am I going to be paying for this annuity if I'm paying anything? And sometimes there aren't an annual cost. If it's a deferred variable annuity, we're going to have an annual cost. If it's an immediate fixed annuity, we're giving them a chunk of money and we're getting a stream of income in return. But just make sure you understand that. How long is a surrender period? If I hate this annuity after 2 or 3 years, how long do I have to wait to get out of it? I have to tell you, for most annuities, it's a minimum of 7 years. So typically, you're going into something with a 7-year agreement. Make sure you understand that agreement. What happens if inflation rises significantly? I'm going to tell you the answer to that. You're going to be in trouble. Annuities are not great products if there's high inflation. It is a problem. And even if there is high inflation and it falls back down to normal rates, that inflation that we incurred in earlier years doesn't go away. It just starts compounding slower. So the price of gas, milk, and eggs still stay high. They just compound at a slower rate. That inflation, once it's there, it stays baked in pretty much for the rest of your life. Is this replacing investments or is it complementing them, right? We never like annuities to replace investments because there's just too many downsides. But it can be a great complement to your investments in the right circumstances. And how is the advisor compensated? In almost every case, they are sales commission based. So make sure that you're getting independent advice from someone who is not earning a commission off of what they're telling you to look at that annuity and make sure they get great information on it.
Those are all really great points. And I think the compensation of the advisor recommending the annuities is something that a lot of people tend to overlook. Overall, it seems like annuities, they're not terrible. You just really need to know how exactly you're using it and really understand what you're getting in the long term.
To your point, Zane, it is not a retirement plan. It is a tool. This is a tool in your toolbox. This is not a plan in and of itself. If you make it your retirement plan, you are probably in trouble because you probably have an inflation problem if you live longer than 10 years. So make sure that you understand that. They definitely can help with guarantees in certain circumstances, but they come at a cost like anything. Another problem is simplicity, liquidity, flexibility, and long-term purchasing power. They all matter. You have to make sure that you're looking at that. And just make sure that you're building a retirement plan that is adaptable over time. If an annuity is the only product you have, it is not adaptable and you're locked in. So if you're analyzing whether an annuity belongs in your retirement plan, this is exactly the type of planning conversation that we help families navigate every single day. So feel free to reach out to us. We're happy to give a look. Tell us you listen to the podcast and you want us to take a look at your annuity, and we're happy to talk to you about it. But I think we've covered both the pros and the cons of annuity. We really did it in an independent way. Of course, we have opinions on it, but ultimately, we really feel like annuities can be a good product, a good tool in your toolbox. Just be careful.
Which I think this podcast idea was great. It's really great to see the pros and see the cons all in one. And even in a 30-minute podcast, just get a brief overview of everything that's going on.
That's it. And all we can do is keep learning and keep planning. Have a great day, guys.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.